Welcome to KonceptCraft. Introducing the Accounting Arena book, your ultimate guide to mastering the fundamentals of accounting. Embrace the world of accounting knowledge at your fingertips. Act now, and get your copy of Accounting Arena ebook. Link is available in the description below. Keep learning. Keep growing. Happy learning. Now let's begin our today's lesson. The balance sheet. The balance sheet is one of the most important financial statements for any business. It shows the financial position of a company at a given point in time by listing its assets, liabilities, and equity. The balance sheet can help you understand how well a company is managing its resources, how profitable it is, and how solvent it is. Here are some key points to remember about the balance sheet. Assets are the resources that a company owns or controls, such as cash, inventory, property, equipment, and intangible assets like patents or goodwill. Assets are classified as current or non-current, depending on how quickly they can be converted into cash or used up in the normal course of business. Liabilities are the obligations that a company owes to others, such as suppliers, creditors, employees, and taxes. Liabilities are also classified as current or non-current, depending on when they are due to be paid or settled. Equity is the difference between the total assets and the total liabilities of a company. It represents the owner's claim on the company's net assets. Equity consists of share capital, retained earnings, and other components such as reserves or accumulated losses. The balance sheet follows the accounting equation: assets equals liabilities plus equity. This means that the total value of the assets must always equal the sum of the liabilities and equity. This equation reflects the dual nature of every business transaction. Every transaction affects both sides of the balance sheet. The balance sheet can provide useful information about a company's liquidity, solvency, efficiency, and profitability. Liquidity measures how easily a company can meet its short-term obligations with its current assets. Solvency measures how well a company can meet its long-term obligations with its total assets. Efficiency measures how effectively a company is using its assets to generate revenue. Profitability measures how much income a company is earning from its assets and equity. The balance sheet is a vital tool for any business owner, manager, investor, or creditor. It can help you evaluate the financial health and performance of a company and make informed decisions about its future. By understanding the balance sheet, you can gain valuable insights into a company's strengths and weaknesses, opportunities and threats, and potential risks and rewards. A balance sheet is a financial statement that summarizes the assets, liabilities, and equity of a business at a specific point in time. It shows what the business owns, what it owes, and how much it is worth. A balance sheet can help you evaluate the financial health and performance of a business, as well as compare it to other businesses in the same industry or sector. A balance sheet has three main sections: assets, liabilities, and equity. Assets are the resources that the business owns or controls, such as cash, inventory, equipment, accounts receivable, etc. Liabilities are the obligations that the business has to pay or fulfill, such as accounts payable, loans, taxes, etc. Equity is the difference between the assets and liabilities, and represents the owner's claim on the business. Equity can also include retained earnings, which are the profits that the business has reinvested in itself. The balance sheet follows a simple equation: assets equals liabilities plus equity. This means that the total value of the assets must equal the total value of the liabilities and equity. This equation also shows how the business is financed, either by borrowing money, liabilities, or by using its own funds, equity. A balance sheet can help you analyze the liquidity, solvency, and leverage of a business, as well as its profitability and growth potential.